Okay, so step number one, determining gross profit in a bit more detail. So the accounts that we have involved in this step is sales and cost of sales and sales returns, if you have it. And the final account that we'll use for this calculation is the trading account. Okay, so every time I say closed off transferred, I mean debit and credit. So you can read in brackets on the slides. So the first step that you do is you take sales returns and you close it off to sales, okay, to get a more accurate sales figure. Then you take your sales account and you close it against the trading account, and you do the same to cost of sales. So your cost of sales you also close to the trading account. Balance the trading account. That balance is your gross profit. That's step number one in a bit more detail. You take that gross profit, you go and transfer that over to your profit and loss account, okay? And that's kind of what step number one over here is all about. So in this step, we have nominal accounts involved, all your other income and expenses. Final accounts involved is your trading account from the previous slide, and your profit and loss account to carry this calculation forward. So as I just said, when I move to this slide, profit on the previous slide that you calculated, you now move to the profit and loss account. You close off all your other income, number two. Close off all your other expenses, number three. Put them all into the profit and loss account. Balance out the profit and loss account. That is your net profit, final profit for the year. Okay, and that's step number two in a bit more detail. So you take your trading account profit, move it into profit and loss, move all your income and expenses into profit and loss, balance out profit and loss, and you get your net profit for the year. That net profit then, over to step number three, is transferred to capital. Okay, this is really where you see the profit becoming equity, the profit going to the owner. Okay, it's actually quite an important step. You've kind of been waiting your entire semester to actually physically see this in accounting. So we take that profit and loss balance, we move it to capital. Now, what is quite important to just take note of is the side of which your entries would be, whether it's debit or credit. In this step would very much depend on something I highlighted at the bottom here, whether the business is making a profit or a loss. Okay, so remember, if the business is making a loss, it'll be negative for capital. And if the business is making a profit, it would be positive for capital. So it really does depend on if your expenses are bigger than your income, you'd be making a loss. You still transfer that to the owner, okay? That doesn't change. So you just follow your debits and credits. But it's important to note that irrespective of whether you're making a profit or loss, it will always go to the owner, but your debits and credits has to make sense. Okay, as I mentioned there at the bottom of the slide, this is the first time we see how profit becomes equity and how the owner is entitled to the profits of his business. How we do this in accounting is not by saying it to someone. We do it by moving profit to capital, debit and crediting, and effectively then changing the classification of profit to equity. Okay. Bit of a note for when you guys do second semester accounting, you'll do partnerships, you'll do closed corporations, maybe even later on in accounting too, you'll deal with companies. It's important to note the step of profit always becoming equity, always being transferred to equity. Whatever business form you do, that never changes. This principle of profit belonging to the owners of the business. Okay, so here you see it, and this is how we do it in accounting, by debiting and crediting. Okay, then over to our last step. So we've put our profit into capital, over to the step with drawings. So what we do is we remove drawings to capital by crediting drawings out and debiting it into capital. Okay, the reason why we do this is because throughout the year we've been classifying drawings separately. It is equity, but we've been classifying it as a separate entry. It has a negative effect on equity, but because it's year end, we're trying to get a complete picture, a more compressed figure. And it's just logical for us at this point to say, well, I'm going to merge drawings with capital to get a final number of my equity. Okay, so yes, drawings does have a negative effect on capital, but you need to get a one number summary. So you need to close drawings off to capital. Okay, so then what you are left with is balancing the capital account. And that capital account now includes the profit that we've transferred in the previous slide and the drawings. Okay, and that in total, that balance of that capital T account is the year-end value of owner's equity. Okay, and again, you can see here again, the closing balance of capital is the opening balance of capital plus profit minus drawings. Okay, something we've actually worked with in Learning Unit 2 in our accounting equation.